We've already seen a lot of hype from one paragraph from this author, but let's move on and read the next paragraph. Selling credit spreads takes advantage of the fact that the value of any option declines as the expiry date of the options approaches. It does this particularly fast during the last 30 days of the life of the option. It has been said that 90% of option buyers lose their money. This means that those who sold the options to those unfortunate buyers win 90% of the time. This is just plain out and out wrong, an urban myth. The author is leaping to the very dangerous assumption that if you write options, that you automatically have a 90% probability of winning. But according to the Chicago Board Options Exchange, which is one of the largest options exchanges in the world, only about 10% of options are exercised during each monthly cycle. The naive assumption is that 90% of options expire worthless, which is probably where this myth came from. But in actual fact, only about 30% of options expire worthless in each monthly cycle. In fact, over 60% of all options are traded out in the marketplace. That means that options that have been bought are sold before expiry, and options that have been written are bought back before expiry. All of these figures are academic anyway, as they give us no indication as to the ultimate profitability of the various strategies. The author then goes on through a list of attributes of credit spreads. Let's have a look. Now, I'll be going through these one at a time, so rather than reading them out here, I'll deal with them one by one next up. The first point of the author, it is short term. Trades are typically less than 30 days in duration and take advantage of short-term trends in the market. Yes, most people construct these trades with a short time to expiry, and I agree that as you want this to expire above the written price, the shorter the time to expiry, while still being able to get reasonable net premium, is appropriate, with 3 to 6 weeks being most common and quite typical. But you are not taking advantage of trends at all. Later on in his list of points, the author says that market fluctuations are largely irrelevant, and they are, so long as the share is not below the written strike at expiry. So what we are trading here is where we think the share price is not going to go, not where we think it is going to go. This might seem a pedantic point, but it is important, because if you think the stock is going to start trending, there are much better strategies for that specific purpose. You might still use a vertical spread, but you'd select completely different strikes. Point 2. It is low risk. Trades have a better than 90% chance of success, always. You know exactly what the risk, return, and profit will be before you enter a trade. There is no guesswork. Profit is up front. A trader gets his profit immediately and only needs to protect that profit for a short period. Here we revisit the 90% of options expire worthless fallacy. We've already dealt with this, but it is worth reiterating that 90% of options do not expire worthless. Only roughly 30% of options expire worthless. In any case, this statistic has little to do with the probability of success of our position, as this depends on the strike selected. Also, the author confuses probability with risk. Ultimately, the risk of this position is the dollar amount of maximum loss. Chance of success has little to do with risk. In fact, risk is high compared to reward. We've seen that from our example in a previous slide. But that really isn't even the bottom line. As we've seen, 90% of probability of success is totally erroneous, based on the author's assumptions. But the bottom line is, even if you win 9 trades out of 10, how much you lose on that one time out of 10 is more important. With bona fide statistically 90% probable credit spreads, which are very, very skinny on the net credit as a rule, that one loss from 10 can be greater than the sum of the 9 wins. Probability is only part of the deal. You need a positive mathematical expectancy as well. The author states the profit is up front, but a credit does not equal a profit. While it's true that the credit is deposited into your broker's account, you cannot take that money and go and spend it. You are simply holding it as stakeholder. The money is effectively locked up. In addition, you are required to put up an initial margin to cover you for possible losses. Now, it is not within the scope of this video to go into synthetic equivalence, but it can be demonstrated that the synthetically equivalent trade can be constructed with a debit rather than a credit. In other words, you have to pay out to put the trade on, which you do anyway with the credit variety via margin. There's no difference. And it will have the identical risk and reward characteristics. Worth repeating to reiterate, a credit does not equal a profit. Again, defense of the credit spread is not within the scope of this video, but the author does not detail how this supposed profit is protected. In fact, this is very difficult with the credit spread without increasing risk substantially. This is one of the main problems with credit spreads. By the time it looks like it does need defending, the strategy is often in a deep hole. Next point, market fluctuations are mostly irrelevant. The market can continue its trend, stagnate, or even turn against you to a certain extent, and your profit is completely safe and untouchable. While that's partly true, the market can wobble around a bit up and down, and you may still end up with a maximum profit. But quite obviously it depends how far it trends against you. If it trends past your written strike, your profit isn't very safe, is it? If the market starts trending against you immediately, short gamma and vega can be very painful mid-trade. In other words, you can have a large open loss on your hands straight off the bat with no idea of whether the price is going to reverse and put you out of your pain. Once again, how and when do you defend? When the guy on the other side of the trade has his greedy hands on your money, and you don't know where the market is going to go next.